Hello everyone. In this video we are going to read through a deferred tax question. This is an advanced CTA question. As we read through the question, we're going to analyze the information and understand the impact that the information has on the final answer. The requirement. Prepare the following notes to the financial statements of Montana for the year ended 29 February 2012. Comparative figures are not required. So bear in mind over here that a year end has been provided to you. This year end is very important because it helps us jot down key dates on a timeline, and the year end also helps us for depreciation and wear and tear calculations. Even though the last bullet mentions that comparative figures are not required, you need to understand that comparative figures may not be required to be disclosed, but at some point in a deferred tax question, we always require comparative figures to be calculated. So just bear in mind that trick on the last bullet. In terms of the notes that they want us to provide is the income tax expense note and the deferred tax note. Please note the movement in temporary differences in the current tax calculation must be calculated using the statement of financial position method, or some people call it the balance sheet method. So they're informing you about this point to guide you as to how to deal with your movements in your temporary differences. Your answer must comply with IFRS and obviously not any other accounting framework. Let's read the question. Okay. The following information relates to Montana Limited, a manufacturing company which was incorporated on 1 March 2009. On 1 September 2009, property and plant were acquired at the following amounts. It may be assumed that these assets were immediately brought into use. Okay. So at this point over here, I just want to pause and mention to you that by virtue of the fact that these assets were acquired on 1 September 2009, it means that it wasn't acquired in our current year under review of 2012, neither was it acquired in 2011, but these assets were actually acquired prior to 2011. So bear in mind the acquisition date that you see, and as a result, this point over here talks to what I mentioned when we were discussing the required, where I mentioned that even though a comparative year is not required to be disclosed, you will still need to calculate what the carrying amounts are in 2011 and 2012. Property and plant is measured in terms of the cost model, okay, of IAS 16, property, plant, and equipment. So all of these assets that you see over here, land, factory buildings, office buildings, and plant, what you need to remember about them is that these asset classes are measured using the cost model. And by looking at your asset classes, you should basically be able to very easily pinpoint what is depreciable, what is non-depreciable. And also your model or your measurement model impacts the method in which how you determine your carrying amount. Montana Limited provides for depreciation on the straight line basis. Depreciation has already been provided for on property and plant and is included in accounting profit. The depreciation rates are as follows. And then they provide you with the rates for factory and office buildings and for plant, And bear in mind that depreciation is apportioned for a part of the year. Whereas at the bottom, where they talk about your SARS rates, your Section 13 Quin, 5% per annum on factory buildings on a straight line basis, your SARS rates are generally not apportioned, okay? And then for Section 12C, it's 40% in the first year, 20% in the subsequent 3 years. So that you can simplistically put as a 40, 20, 20, 20. Okay, the SARS does not allow any deductions on the office buildings. That last point is also crucial for later. What you need to bear in mind over here is that when you are provided with depreciation rates, and especially in an instance where you're dealing with assets that were acquired prior to the prior year, then it's always good practice to convert your depreciation percentages into your total useful life. Okay? And the next point that you need to bear in mind when you're going to be performing your depreciation and wear and tear calculations is that while depreciation is apportioned for the year, wear and tear is not apportioned. The following balance relating to insurance is included in other receivables, prepaid insurance premiums. So these items over here are important because they impact your deferred tax balance sheet method. And here again, by virtue of the fact of them giving you comparative information for both 2011 and 2012, it means that later on you will be required to calculate the impact on your deferred tax balance sheet using 2011 and 2012. The profit before tax for the year ended 29 Feb amounted to 1.5 million. So as always, profit before tax is always your starting point in current tax workings. Included in the 1.5 million are, inter alia, the following items: dividends received, not taxable, 210,000. So what we're going to do over here is we're going to basically highlight our dividends received in light green because that is a permanent difference. Okay. Fine for contravention of the Companies Act, not tax deductible. Okay, that is also a permanent difference, so we also need to highlight that. Value of inventory destroyed in hailstorm, deductible for tax purposes. Since this is deductible for tax purposes, it has no impact on our tax recons. Donations paid, not tax deductible. Donations paid will have an impact on your permanent differences. And the last point, revenue earned in the United States of America taxed in the US at 33% and not taxable in South Africa, 180,000. So over here you have an instance where revenue earned in the US will have foreign tax implications. This will also impact your current tax workings as well as your income tax expense note. The final assessment issued by SARS for the financial year ended 28 Feb 2011 reflected an assessed tax loss of 170,000 rands, which was accepted by Montana as correct. The board of directors were of the opinion that there would be adequate taxable profit. Okay, so at this point in time, the fact that we have an assessed tax loss, the question tells us that this arose in 2011, so it will be carried forward into 2012, and it does impact on our deferred tax workings. The second point about there being adequate taxable profit merely indicates to us that we can and we are able to recognize deferred tax assets. So it says the board of directors were of the opinion that there would be adequate taxable profit in the future to utilize this unused assessed tax loss, as the company's budget includes new contracts that will generate profit in excess of 5 million for the next 3 years. So that last statement, or that last sentence about generating budgeted profits of 5 million in the next 3 years, that has no bearing on our information. The Minister of Finance announced during his budget speech in Feb 2012 that the normal tax rate applicable to companies will decrease from 28% to 27% for all financial years starting on or after 1 March 2012. This is the first change in the tax rate in 10 years. So here you have it, folks. We have a rate change. So the rate is changing from 28% and going to 27%. Bear in mind that when you're going to calculate temporary differences, you will need to use the new rate, and also the rate change will have an impact on our deferred tax asset and liability calculations. There are no temporary differences other than those that are apparent from the question. That basically goes to tell us that the information that you have over here is complete. I hope that you have found part 1 insightful. Look out for part 2.